Happy end of the week, everybody. Happy Friday. Happy May. It's an exciting time to be alive. I'm working more on my stock market model today. My goal is to have something automated that's going to spit out buys and sells, what to go long on, what to go short on every day of the week. I don't want to do anything other than maintain and monitor the health of the model. Other than that, I just want to crunch numbers to get buys and sells out. So I'm going to start with going over the strategy, where I'm at right now, and then I'll go over what I'm going to be working on today, and I'll get into it. But here's a quick overview. So I have two goals. The first goal: beat the S&P 500 by a significant margin and stay market neutral. So what's this mean? The S&P returns on average 6% per year. Then there are up years and down years. I want to do better than that, 3 to 4 times better. So on average, 18 to 24% per year. And I want the strategy to be market neutral. So it shouldn't matter whether the whole market's going up or going down. I should reliably be getting the same returns no matter what. So here's the layout for that at the bottom. The first thing is to isolate a stock universe from the data. So I don't want to train the model on all stocks. This is going to confuse it. Different things have different price dynamics. Also, I don't want to train it on low volume stocks because that means the strategy won't be scalable. I can't get funded by quant firms, things like that. So I've isolated a stock universe that seems to do pretty well on the data. I'm only looking at real estate investment trusts, ADRs, which are foreign companies listed on the U.S. market, and common stocks, which are things like Apple and Tesla. Then I'm using this universe. Also, the universe updates every month, so it goes through every month. Basically, performs the same filters. Filter out everything that's not one of these. Maybe something's been added to the market, a new real estate investment trust. If that's in the top 2,000 by dollar volume, then I want it in the universe. So it basically goes through and runs the filters for every month, updates at the first of each month. Then I'm using this universe to train a returns model. I've got what I think is a pretty good returns model going. I'll go over that in a second, why I think it's good and why I'm tweaking it. And finally, the portfolio model. So once I have a really good returns model, the portfolio model is going to implement some simple high-level logic, take the outputs of the returns model, and develop a strategy for going long and short based on those outputs. Now, I'm writing all of this code in Python, which brings me to my second goal. So I'm generalizing the code as I go and updating it as I go. Currently, I have the universe defined, and I'm training a good model in under 100 lines of code. And so anyone, I think, should be able to do this for themselves without having to write the whole code base. So you can go in there and do the same exact thing I'm doing. The data is all there. Everything you could want is there. You just need to run some scripts. So if you're interested in that, you can check it out. The link's in the description. Here is the repository. Yeah, so go check it out and, let me know how it works. You could also go to the Discord. That's in the link too. And let me know, what problems you ran into this. How did your own model work? Maybe I could give you some advice there. That said, also please join the Discord. We talk about interesting things there. Please subscribe and please like the stream. So yeah, I have a good model, and here's why I think it's good. So if you look at the red box, these are the metrics I'm looking at, and it's hitting the threshold or beating significantly every metric. So information coefficient, that's telling me about the predictive power. I'm shooting for a goal of 0.01 to 0.02 because the stock market has a notoriously low signal to noise ratio. I'm getting 0.047, so 2 times higher than my top goal, over that. Standard deviation of the information coefficient to information ratio, and t-statistic are all telling me about the stability of the model. For the first one, I want 3 to 13 times the information coefficient. You see here it's about 3 times, so that's good. Daily information coefficient to information ratio, I have a goal of 0.03. I'm getting 0.3, so larger by an order of magnitude. Similarly, on a yearly basis, my goal is 0.3. I'm getting 2.3, so again, larger by an order of magnitude. T statistic, my goal is 1.98. I'm getting about 2 times that. So it looks really good on all of the metrics. Furthermore, this is for a single model, trained from 2011 through about 2019, tested from 2019 to 2022. Validated from 19 to 2022. Hey, Furpo, how are you doing? And tested from mid 2023 onwards. And what's interesting about this, actually, let me look at my OBS studio. No, I'm not too zoomed in. It looks fine. But what's really good about this is if you look at the decile analysis. So, yeah, this is weird. Oh, yeah, there we go. So basically the hallmark of a good decile analysis is the bottom decile, bottom 10% is your worst performing. Top decile, 90% and above, should be the best performing, and it should be monotonically increasing in between. So each decile is higher than the largest decile. That's exactly the behavior we see here. Furthermore, when I did a walk forward analysis of this model, it's hitting the goals for information coefficient and annual information coefficient to information ratio every single year. So for these reasons, I'm really confident in this model. Very good, Furpo. I got, after I did my stream last night, I was looking around at stuff and I found what I think is a really good strategy. So I think I just need some final tweaking, fine tuning to this, and I'll be able to go ahead and start paper trading. I'll show that in a second, but I like to, at the beginning of the stream, I like to go over everything because then they get posted as videos later to my channel. And this helps keep people engaged in the video if there's some introduction where I'm explaining what's going on. Basically, here's the problem I was having with this model, is it did really well after 2023. Basically, almost any strategy on the portfolio level I tried to implement, it did well. When I tried the same strategy that's working well for 2023, going back to 2016, you see it basically lost money from 2016 until the end of 2021 before turning it around. And so what this is kind of indicating is it's performing well on later years, but poorly on early years. Conversely, if I optimized the model to work well on the early years, which I did here, so basically did an optimization, find the best portfolio parameters for the early years from the beginning of 2016 through mid-2018. So if you look at that region here, beginning of 16 through mid-2018, it did really well, but then it lost money basically beginning of 2019 through the beginning of 2021, and then it flatlined from 2021 to 26. So the problem is basically that if I get something which works well on these early years, 2016 to 2021, it fails after that. If I get something that works well on these later years, 2022 and onwards, it's failing before that. And the reasons for this, there could be 2 reasons or more, something that I'm missing. But the first reason, I think, is if we look at this dispersion here, dispersion in the market increased significantly in 2020. So there were a lot more retail traders and a lot more stocks were listed. A ton of stocks have been listed since 2020. It's like exponentially growing the number of stocks in the market. The other thing that's going on is interest rates were almost zero during the 2010s, right up until 2022. And in 2022, they started getting jacked up, and they're no longer negligible rates. And so because of that, there's basically these 2 regime changes that occurred around the same time. The market became more dispersed because there's a lot more stocks. Yeah, I know, my hair's growing. And if you look at the streams from the very beginning of this project, at the beginning of the year, my hair is very long. So, yeah, my hair is now significantly longer. I need a new thumbnail. But this thumbnail, seems to be working pretty well. And I'm a big believer in minimalist streams. I don't want to edit anything. I don't want to change anything. I just want to go live and live life as I'd do it otherwise. But yeah, basically, problem is, if it does well on early years, it does poorly on later years. Vice versa. If it does well on later years, it does poorly on early years. the transfer in performance goes right along with the change in dispersion that happened in 2020 because there are more stocks listed and more retail traders participating in the market, and the change in interest rates that happened in 2022. Both are right around that inversion point. So the next thing I wanted to do was look at, how does the model look in the walk forward? And actually, it looks pretty good, but it's not perfect. And you see that this isn't perfectly monotonically increasing in every year of the model. Additionally, some years where it's not performing well, like 2020 for instance, it's hard to get it to perform well. The best performing longs, the scale here, the vertical scale, is from minus 0.06 to 0.02. If you compare that to some years which did really well, like 2021, for instance. So 2018 is the worst performing, 2021 is the best performing. And you see here, 2018, it doesn't look very perfectly monotonically increasing. And look at the spread. It's from minus 0.04 to 0.02. If we look at 2021, which did really well, it's very beautiful. It's clearly monotonically increasing, and the spread is really high from minus 0.2 to 0.15. So what next? So next I looked at trying to improve this walk forward analysis. So I'm using only the metrics that were deemed important. So everything that has a coefficient of variation less than 1 will still having a mean importance above 0.05. So here are the results, the decile analysis charts with that model. And they look a little bit better, but still not perfect. But you see, like 2018, for instance, it's still kind of a low range. And so I'm struggling during that region. But if you look at now with this new model where I've dropped out, I'm only keeping the important features from the previous walk forward. You see now it's not going negative in these early years. And actually it looks like the problem shifted. So it does fairly well from 2016 through 2020. Now it's failing during the COVID regime, 2020. And then at the beginning of 2021, it starts to flatline. End of 2021, it starts going exponential. And it did really well after that. So the problem has shifted now from these two regimes, good at late times, bad at early times, or good at early times and bad at later times, to now good over the whole time period with the exception of the COVID crash. So next I'm looking into a model to kind of mitigate the COVID crash. So I trained yet another model. And so this one, earlier before I picked Sharpe ratio as my target, I tried, I should just say, here, this is just changing the number of validation years. So more validation years, basically you're going to get a better hyperparameter tuning for the optimization. The things like the learning rate and stuff. So this is kind of interesting. I finished looking at this morning. So, before I was doing Sharpe ratio as my target, when I just had returns as the target, I found that I improved the model if I was incorporating the some sector neutralized features, basically mean reversion features. Yeah, I'm still using Claude. I switched between Claude and Google Gemini, but I like Google Gemini better for coding and stuff. I think it's better at logic, but I'm still using both. I haven't used Claude in a bit though, but I'll get back to it. I haven't been using Gemini so much that I'm running out of requests. So basically I found that mean reversion features and volatility features should be incorporated relative to the sector. And if I keep everything the same as the really good model I had and just added these features into the sector, I found that the model was performing a lot better when I'm predicting returns, log returns as the target. And so the question is, do these improve with the Sharpe ratio? And so the top is with everything implemented, and the bottom I'm doing the same thing again, keeping only the important features from the top model. And you see actually the top model performs better. It looks better on the decile analysis charts. It's just more monotonically increasing. And additionally, the spread on the decile analysis charts is better with the top model with all of the features. So I'm going ahead and looking at this. Now, this is what I found that's really good. So if I do this Portfolio Explorer, I found I was messing around with this morning, but basically I'm doing incorporating a portfolio strategy based on these results, and all of this stuff at these portfolio strategies. This is basically this plot is basically showing here's the implementation of a portfolio strategy from the results of this model. And so this is using very basic scaling. This is seeing, scaling down if the model had a low win rate over the last 20 days. Um, Scaling down if volatility is high, volatility of the portfolio, and also scaling down if there's a big drawdown. So you see during this period, 2020, where it had a drawdown, the mean value for gross exposure is really around 0.4 something. And also the turnover dropped during that time. What I just incorporated this morning after I did a stream this morning. So after that stream this morning, what I incorporated was also scaling based on the information coefficient of the model. So the idea is when the information coefficient of the model drops, scale down exposure to some minimum. When it goes up, scale the exposure back up. So and with this strategy, I'm actually getting very good results. Here they are. So you see, I'm not able to really solve this COVID drawdown. It's just a rough drawdown. It lasts for a long period of time. You see here 561 days from the point where it first started to come down to the point where it returned to that value. So it first started to come down here, May of 2020. It got killed all the way through the beginning of 2021. So the whole second half of 2020, it would have been losing money. And then it started recovering in 2021, and it was back to being recovered by almost 2 years later. So that's still pretty bad. But there's some good things here. So even though it fell that much, you see the returns increased to almost 100% returns over these 4 years. So the first 4 years of the model, I got 100% returns. So that's really good. And then it dropped during COVID down to here. But even at the worst drop, I was still up, 38% or so. So that basically made it so I could eat that loss. And so, but if you look at the metrics for this, the mean annual return, 25%. That's excellent. Sharp ratio from 2016 through 2020, beginning of this year, 2026, is 1.44. So this all looks really good. I think I just need to tweak the exposure scaling a little bit. So I think what I should also tweak it on, because I'm tweaking it on the information coefficient. So if the rolling information coefficient goes high. Just recently started to learn any Python. Oh, got any tips? Yeah, my main tip is you just need a project to work on and start working on it and work on it every day. And then you'll be the master of Python. It's lots of people seem to think you don't need coding anymore, but that's just like a phase we're in. It's all hype. If you know how to code something, you really understand it inside and out. So yeah, you just need a good project to work on and hit your head against the wall every day, and you'll be a master of it. So, yeah, so these results are, I'm only scaling based on the information coefficient. So you see in green here is the information coefficient. I'm saying when it drops below 0.01 on a rolling basis, lower the exposure. So, like here it dropped below 0.01. So, yeah, that would be somewhere around here. And you see if you look at exposure during this time period, 2019 through February to May of 2019, Yeah, you see the exposure scaled down significantly. But then you don't want to keep the exposure too long. So when the information coefficient starts coming back up, I'm bringing the exposure right back up. So that helped mitigate the 2020 losses. But the problem is this drawdown is still lasting a really long time. And, um, 2020, COVID is an exceptional event. So it might just be, hard to make something that works during this period. Um, but really, I would be more confident if I had something that worked better. I would like a little bit less of a drawdown and less of a time to recovery. Um, yeah, so basically, this should be thinner, and hopefully, not as extreme, but I can deal with the extremity of it. Um, okay, so let me pull up Google AI Studio. Okay, so let's go over this. So I have a model which is quite robust on predicting 5 day on predicting Sharpe ratios over the next 5 days. I am scaling down exposure according to portfolio volatility, rolling IC of the model, and and drawdown of the portfolio. These work well at producing the pasted results for a long short strategy. I want to also scale down exposure based on the spread of the predictions. Higher spread should have higher exposure, and lower spread should have lower exposure. It should be the rolling spread over the last n days. Portfolio.py contains the code for implementing the portfolio strategy. Below pasted is the portfolio strategy as I am running it now. Work, stock market, tool, scripts, portfolio. Very good. Now here is, I need to run this again. So before I finish the strategy, I'm using 5 days, but I want to look at how does different, is 10 days better than 5 days? I found earlier that the further I'm looking out for my target, the better the predictive ability is, and this is because basically the further you're looking out, the lower the signal to noise ratio is. Okay, so let's give it the strategy. Ex post realized risk. The breaks, volatility, and drawdown scaling. These are reactive. Ex post alpha. This measures if the market is currently rewarding your model. If IC drops, regime has shifted, so you cut exposure. Before you even execute a trade, you're asking the model, how clear is the signal today? If the model predicts everyone will have a Sharp of 0.5, it has no edge. Take today's cross-sectional standard deviation. Oh, so this will be with spread scaling. I didn't think about that. Okay, come on, hurry up. Okay, this should be done soon. So I'll take this opportunity to say please subscribe, please like the stream. Check out the GitHub, the link's in the description if you find it useful. You can make your own model for yourself, define the universe, create a model in under 100 lines of code. Yeah, and if you find it useful, please star the repository, watch the repository, and follow me on GitHub. That stuff helps me out. So if I'm just using this scaling, it's working better than if I add in the spread scaling. Could go to hell, but we'll probably be fine. Oh, paper trading's whenever I'm confident in this model. So, um, honestly, this looks really good and is honestly pretty close. I want to see if there's anything I can do to fix the problem during 2020. Um, yeah. So that's basically my task right now. I want to improve this dip, but if I'm not able to improve it, then okay. Um, so here's with that scaling. I lowered the floor basically. Um, and so the exposure is getting close to 0.2. So how did this perform? So pre-pandemic, I think it raised, yep, to about 100%. Then the pandemic happened, and it marched downwards from May 2020 through the beginning of 2021. It marched downwards. So that's kind of my problem right now. I don't think I could have tolerated 6 months of losses, 7 months of losses. However, by 2022, second half of 2022, I recovered back to where I was. So in about 2 years, it recovered. What's the drawdown duration? Yeah, 561 days. But average profit of 25% per year is pretty good. So what if I change the floor down to 0.1? And let's use a longer look back. So if the spread's lower than it's been over the last year, scale according to that. So more intense penalty with a longer look back. So if I set the floor to 0.1. Oh. May 2020 through July 2021. Are there any scaling strategies which might solve this problem? How can I make the model itself work better during this time period? Hey, Sir Night Night. Good afternoon / evening. Welcome to the quant winter. At least seems like it got that from some established source. I feel like it's actually a Lil Wayne Drake song. It's looking really well. Look, here's where I'm at. So if I tried using stronger penalty and a longer look back, that did lower my exposure during 2020, but that really hurt the overall returns. But it went from up 60% to up 60% to up 7%. Hey, Drew. Okay, sounds good, man. How'd the first race go? Yeah. The trans girl? Oh. Uh-huh. Wow. Peak. It worked. Wow. That's got to be maybe the most exciting thing to coach. Wow. Whoa, geez, holy smokes. Wow, dude, going under 11 is crazy in high school. Wow, that's impressive. So what's the last race? Oh, so it's the same girls racing the 200? When's that? Oh, nice. All right, cool. Call me when you're done. Good luck. All right, see you, Drew. Yeah, that's exactly what I was talking about, Sir Night Night. The quant winter. You know, if I keep having trouble in this time period, at least it's good to know there was a quant winter that went on. Um, so if I remove volatility scaling, basically if I'm only using IC and drawdown scaling, it's not working. So let's change target volatility to 0.1. All right, so let's see what happened. This period is known in institutional finance as the trash rally or the everything bubble. Central banks injected trillions and retail traders flooded the market. Fundamentals ceased to matter. Um, Bankrupt, highly shorted, high volatility companies went up 300 to 1,000%. Your HRP allocation balances dollars. But in 2020, junk stocks had betas of 2.5, while quality stocks had betas of 0.8. Being dollar neutral meant your portfolio had a massive negative net beta during the strongest, fastest bull market in history. To survive a liquidity driven melt up, you cannot treat the long and short sides equally. You need asymmetric scaling and regime scaling. Trend/broad market scaling. When the broad market. Wait, what do you mean the risk off period? When the broad market is in a massive uptrend, shorting becomes mathematically toxic. Yeah, so this is with a little bit more intense punishment. Still, it's just drawing the exposure too low. So I can keep that punishment the same, but say maybe only look back 10 days. Maybe that will stop it from drawing down so much. What did I change? Oh yeah, target volatility 0.1. Risk off for your strategy, where I think you flip your logic. You mean what I'm looking at now, trying to weight it long and short weighting? It has something to do with that. And I think I can basically account for that. Where did my mouse go? Ayo. Okay, cross-sectional correlation scaling. When the broad market is in a massive parabolic uptrend, shorting... yeah, okay, I know that. Calculate a moving average trend filter in the overall market universe. If the 20-day moving average is screaming upwards, scale down the short side independently of the long side. Okay. Cross-sectional scaling. During May 2020, everything went up together. When the correlation between all stocks approaches 1, alpha becomes impossible and beta dominates. Okay, that doesn't look much better. I mean, that's basically making things more extreme without giving me higher returns. Before sizing, calculate the rolling 60-day beta of your longs and your shorts against the market proxy. Implementation. If your short basket has a beta of 2 and your long basket has a beta of 1, beta neutral. So beta is market movement, alpha is individual stock relative to the market. If your model is trained to predict raw return, it will be bad. Short squeeze and crowding features. Today's date is 5/1/2026. Alright, so the first thing is look for an optimal time period for the model. So that's the first thing. Do adding macro / regime features improve the model? How do I add these so that the model doesn't break like in my previous findings? If you feed raw RSI or raw volume into the model, a volume of 10 million might mean high volume in 2018. Measure the average pairwise correlation of your universe. scale down exposure with higher total cross-sectional correlation of universe. Scale shorts longs according to market trend. Okay, so optimal time period is important. Macro regime features I need to look into. Short interest, I kind of don't think that's going to be easy, but I'll see if I can. Beta neutral portfolio weighting should be a big improvement. Scaling down with cross-sectional exposure, that'll be some improvement. Scaling down according to the market trend. I think that could be a big improvement. So these are the two to focus on. Okay, so yellow first thing to do, orange next thing to do, red leaving off for the future. So that's what I'm going to focus on the next streams. That's it for right now. I might do another stream later tonight if I get some free time. I'm going to go eat dinner with my brother. And if I don't do another stream later tonight, I'll be doing one tomorrow, at least one tomorrow. So we've got some good results. We need to basically, I've got a portfolio that looks good. I need to make it do better over 2020, mitigate this 2020 problem. If I can figure this out and have it return positive, basically lower this drawdown duration to, I'd like to have like a month be the longest drawdown duration, but we'll see if I can do that. Maybe a couple of months, but really this year and a half drawdown is killing me. So that's what I'm trying to figure out. Thanks for watching. Have a good rest of your night. Adios. Better over 2020, mitigate this 2020 problem. If I can figure this out and have it return positive, basically lower this drawdown duration to